Well, thank you, audience, first of all, for being so patient and waiting till this point in time where, it's been a long day. Thank you so much for sticking to us. Sticking with this event up till now. And I'm going to assure you that we are not going to be left any less entertained by this panel because we seem to have the most claimed entertaining CFOs, self-claimed entertaining CFOs in India. So this session is on a very important subject, and that is inflation. This has been the pain point for the finance community and certainly for the economy. And we are going to explore with the CFOs, with 3 CFOs and 1 economist in terms of the way ahead for the business community as well as for the economy as a whole. So let me just reintroduce my set of guests for this session. Mr. Joydeb Chatterjee, who is the Senior Vice President and CFO, Packaging Films Business at SRF Limited. Next we have, of course, Mr. Anand Agarwal. He's a CFO. I'm sure most of the CFOs would feel envious of. He has a huge amount of cash on his balance sheet at a time when inflation is hitting CFOs very hard. So, Mr. Anand Agarwal, thank you so much for your time. And he's actually coming after his board meeting. So that shows his commitment for all of us at ETCFO, and it's really highly appreciative. Next, we have Ms. Yuvika Singhal, who is certainly going to give us certain antidotes for the economy, which is in some dire straits, so to say. And next, we have Mr. Hemant Ruia. He's CFO DP World, and he is humble, but his benchmark is now Prashant Kumar, I have learned. So that is where I'll sort of end with the introduction part. Now, quickly beginning this conversation with Joydeb, if I can start with you, and ask you with the most recent topic or the news perhaps, which is now the RBI. If we just look at earlier in the day, now there is 50 basis points, another hike that the RBI has already done. This makes now interest rates of 50 basis points more costlier, which means now it is 5.4%. So overall, 90 plus 50, 140 basis points since May, the regulator has already done, and that's reflecting the global trend, wherein US has led this overall fight against inflation by hiking interest rates. So if you could just give us some perspective in terms of how do you view this interest rate hike for your industry in respect of demand?
Okay, hi, check. So actually, the interest rate rise in India, they all generally shadow the Federal Reserve. Always been the case, These all depends on the foreign institutional investors rising the interest rate to comparable to control the inflation and also ensure that the FIIs flow back into India. In terms of our business, what I can say is that SRF is a very capital intensive industry So it's at a conglomerate. It is into packaging films, it is into chemicals, it's into technical textiles, and it's into refrigerant gases. So all are very capital intensive. So what happens is that there is a fair share of internal accruals and foreign currency loans and the Indian loans also, which helps to expand the business. Rise in these interest rates actually impacts the loans, the pricing of those loans going forward. 2 is that we have a reasonable amount of short-term balance between short-term and long-term because we take the short-term loans for managing our working capital, which is one area where the interest rates will get impacted. The forward rates for foreign exchange will get impacted, but we are largely an export-driven organization, so we have a what you call a natural hedge most of the time. So, but for certain capital expenditures, which we use certain banking tools like the UPass, LC and all, where we need to hedge, these foreign dollar hedge rates will be impacted by this increase in prices. That's that extent it is, but being largely an organization which is export oriented and natural hedge over 90%, we don't see a significant impact in our business per se.
So is it fair to put, Joydeb, that inflation per se is not a significant worry for you and hence nor is demand for your industry?
Inflation is worry for everybody. The point is that those who are into the discretionary goods, manufacturing of discretionary goods. What do you mean by discretionary goods? Like, if you want to buy a car or a white goods or a mobile phone, which you want to defer in difficult times. We are in an organization which is basically essential commodities. You can't be, SRF is touching your lives everywhere. So if you are sitting in this room, the gas which is in the AC is by SRF. If you're in the car, the gas is by SRF. We have chemicals patented for agrochemicals and the pharma industries. Packaging films, the fast food are packaged by SRF. So, we are largely in essential commodities. So inflation does impact the demand, but since it is an essential commodity, one cannot live without it. One has to.
Hence, you don't see a significant impact on demand.
Don't see so much.
Okay, yeah. That's nice. Mr. Agarwal, let me come to you. Your sector is an apparel one, and there also, a significant divide, so to say, happens especially on the rural as well as urban front in terms of the interest rates. So again, the same question: how do you view the interest rate hikes for your business in respect of demand?
Hi, good evening, everybody. I think inflation and interest rates impact everybody. So it's a misnomer that if I were to say that it doesn't impact me or my business. But there are various aspects. So from my perspective, from my business investment perspective, my investment decisions are taken not because there's the interest rate is low or it is going to get high. The capex cycle is, let's say, 10 years or 15 years, and I decide basis what is the ROI that I'm going to get in that investment, irrespective of what the interest was today, if it is going up by 50 basis points or not. But definitely the demand, if I look at the consumption side of the business, there is, as Joydeb rightly mentioned, there is a set of customer which has a discretionary set of demand. And typically fashion products lie in the discretionary set, and there is let's say, an impulse whenever there is a higher cost of capital or lower disposable income to push that demand away or aside for some period of time. And that is where the inflation sort of hits the demand pattern. And that is where, we have seen that happening for the last at least 3-4 months, obviously led not only by inflation, but more by global uncertainty, supply chain challenges, and I would say it is more a supply-led inflation rather than a cost-led inflation. What we are seeing today as a rectification measure by the governments around the world is to control the money supply, is to take monetary measures to control some part of that inflationary pressure. But at the end of the day, what is actually happening is that, as we have also seen after COVID, it's been like a K-graph recovery. The rich have got richer and the poor have become still poorer, because the actual disposable income which is still left with them has actually gotten less. And with rising interest rates, their purchasing power actually even, gets smaller. So that is the big worry. But having said that, I think the markets and businesses have always discounted this expected, interest rate hike, and it has not come as a surprise. So if you look around the world, when Fed increased the interest rates, Bank of England increased the interest rates yesterday, India increased the interest rates today, I think there is no surprise. But yes, it is definitely a cause of worry. How long is this going to last, and by when should we start seeing ease in the capital flow so that demand can come back again?
So Mr. Agarwal, just to reiterate, you said that market has already discounted such sort of rate. So when it comes to its implication on demand, you don't see much impact on demand as yet. Is it fair understanding?
No, definitely it will have an impact, and it will have an impact on the discretionary side of consumption. It will definitely have that.
So that means apparel's industry is going to suffer a bit?
A little bit, yes. See, fortunately or unfortunately, apparel or food items are such that you cannot live without. So there is some bit of tapering which will happen, but definitely there is some impact which should get in.
Okay, let me turn to the other CFO before I come to Yuvika as an economist view. So Mr. Ruia, you come from an industry which is so extensive and so large and wide, which is infra and logistics that way, DP world. and you have had, various exposures across industries, not necessarily infra. So what is your sense of the interest rate hike in respect of your business industry, in respect of demand?
Thanks, Manu. Thanks, Manu. I think interest rates would impact on our side CapEx, correct? Now, CapEx, you have built in an ROI already. The problem, so I'm only going to defer my CapEx, if at all, if I see the demand tanking big time. Because slight movement in demand may not really adversely affect your ROI calculations. It's only when your ability to, those 50 basis points or 100 basis points, or even up till now, let's say YTD, we have seen 140 basis points increase in interest rates. That's not going to really matter much. What will impact is when the downstream demand really tanks. That's when, if you're building capacity to take care of anticipated demand, which is you are anticipating will happen in the future, and that does not come, then you have idle capacity and you're paying for it. So that's when you are worried. So effectively, I would say people whose ROIs are a little higher, by movement in demand, ceteris paribus, by movement in interest rates, ceteris paribus, they're not going to be impacted much. But where the ROIs are, just about there, single digit types, and interest rates increase and the demand moves a little, that's when they become edgy, because then you're possibly looking at, am I going to have a positive ROI or am I going to go down under? So I'm going to be worried if I have a low ROI built into my CapEx plans and the demand moves a little more than my comfort level. Otherwise, I think as long as the demand doesn't tax substantially, a good CapEx plan will still hold irrespective of the interest rate movements.
That's a fair perspective, Mr. Ruia. I'll just now turn to Yuvika. So, Yuvika, in terms of growth and demand specifically, there is a view that there are, in fact, two views. One is that now the pandemic is exiting, or it has almost exited. India is likely to sort of, come stronger, and there is going to be economic revival on the cards, and that's going to pick up pace as we go ahead. Second is that we perhaps may be heading to the same 2019-20 period before pandemic, wherein we were actually facing a slowdown even before when the pandemic had struck. So, and that is, where the fear is coming of jobless growth. So, in that perspective, do you think interest rate hikes to curb inflation perhaps, would lead the economy into the first scenario, which is the 2019-20 scenario?
Thanks, Manu. So when we always talk about growth and inflation in the same breath, as economists, we always talk about a trade-off. You can't have high inflation and a very fast growing economy both at the same time. There is bound to be overheating, there's bound to be inflationary pressures, and there's always a trade-off. Now, as an economist or a policymaker, the biggest task at hand, or a difficult task at hand, is to balance the two. Now, we know inflation is above RBI's upper threshold of 6% for the last 6 months. We know it's above 7% for the last 3 months. This is bound to have an impact on demand, especially demand for both, I would say, some part of essentials, because a large part of it has stemmed from food and fuel. So, as a household, I will be a little stingy of what I'm consuming. I'll be watching my pockets. And a bigger impact obviously will come on discretionary demand, something which is not of utmost importance. I would want to postpone a purchase. And we are already seeing the roots of it somewhere in the data, that we do see rural demand on a lower turf. We have seen lower rural demand continuing to slow down over the last 2 quarters. Urban demand, on the other hand, has been slightly better in terms of recovering, largely because it stems from a complete lockdown during the pandemic. But even there, we find that there is a shift that is happening away from goods towards services. So all that pent-up demand theory of demand support that we had spoken about last year is now moving towards services, and we see some slowdown as far as demand for goods is concerned. And this is something we think is going to continue for the second half of the year, fiscal year, as a story where demand is concerned. Now, the question is, when we talk about hiking interest rates, how does it impact demand? We have to understand that when RBI increases interest rate, how does it impact people like you and me? It makes the cost of borrowing money, or deleveraged consumption as we call it, more expensive. But we also have to realize there's a very small part of India that works on a deleveraged consumption, which is largely an urban phenomena. In comparison to rural consumption, you wouldn't see a lot of leveraged consumption happening there in the rural side of the economy. So it largely remains an urban phenomena. So with interest rate hikes to curb inflation, one, there is anyways going to be an inflation impact on demand. The second line of impact is going to come on urban consumption, we feel, largely because your leveraged consumption is going to get more expensive. On the other hand, we feel that as we go towards the second half of the year, the rural consumption could look seemingly better, largely because of two reasons. One, we have seen a normal monsoon, though there is discrepancy in distribution, I will not deny that. But by the time we get into a Kharif harvest by September, October, and the monies flow into the rural economy, I think that should be supportive. And second, that government's focus on rural spend has remained fairly intact in the post-COVID era, and I don't think that is going away in a hurry. The amount of pump priming that has happened through fertilizer, food subsidies, even a lot of other spending that the government has provided or continues to provide. So that support to rural demand should start looking a little more upbeat in the coming months. But it is the urban consumption which could see some bit of slowdown in our sense.
So overall, services might be picking up, but as a whole, demand may continue to remain a bit subdued overall this year throughout.
I would believe so, that urban consumption, especially for goods, could see some downside.
And RBI has retained its 7.2% growth forecast for this financial year. So have you?
So we are at 7% and we are sticking to 7%, though of late we have attached a downside risk to it, largely because of global spillovers impacting India through the external channel of exports. So we see so far up till June, we have seen a very healthy export momentum continuing. July was the first number for exports where we did see export momentum slow down. It dipped into negative for the first time in as many as almost 5 quarters. Even going forward, we think the impact on exports will get more pronounced. We are globally talking about a slowdown in growth. IMF has cut global growth forecasts to 3.2% for this year, even lower, below 3% for next year. So that slowdown in demand is bound to have an impact on our export growth momentum going forward. And that is going to reflect in GDP. Though it's very hard to, it's just early days yet when we are seeing that impact on exports. So we have not ascribed a number to it, but we have definitely added a downward bias to our 7% growth number for this fiscal year.
That helps. So I'll just pick up from the exports point of view and turn to Joydeb. You said that, of course, inflation is a pain for everyone, but demand, you don't see significant impact as yet. If I were to just attach Yuvika's proposition here, exports, we haven't seen, they just I think, slid for the first time in 19 or 20 months. And there are concerns about global demand slowdown. In that backdrop, you are an exporter. That way, natural hedge you mentioned, in your answer first. So in that backdrop, aren't you worried about the global slowdown in terms of exports? And if you can just, also add in perspective from your investments point of view, anticipated demand, if at all do you see coming down, then how are your investments, shaping up?
So to answer this question, first there's 2 parts. You first mentioned about the demand. As I had mentioned earlier, SRF is a conglomerate of multiple businesses. So there are four verticals in the sense that there's technical textiles, which is largely a domestic market, very little exports. Packaging films, yes, significant exports. Chemicals and refrigerant gases, yes, there are exports. But chemicals and refrigerant gases, the businesses are a little different. There's a huge investment in research and development in chemical business because these are chemical formulas which are patented. And once you get the patent, you are one for all. So the investments cannot come down in that area. So it has to continue. So therefore, in terms of investment, we have to continue our investment in chemical businesses. In case of packaging films, yes, there is a drop in the demand. We have seen it of late. That's because our exports to the United States of America and the Europe has been impacted. And largely Europe has been impacted because of this Russia-Ukraine war. Europe has gone into recession. We have a plant and a business in Europe and we can feel it every day. We have a business in Southeast Asia, Thailand, and also in South Africa. They aren't so much impacted as much as Europe is impacted. So to answer to echo what she is saying, yes, in some segments the demand has been impacted, but as I had said, there are other segments which are making up for it because you cannot do without refrigerant gases. Because in USA, there is anti-dumping duty on imports from China. So there's the only other option is to buy from India. So we are one of the only suppliers producing certain kind of products. So therefore, they have to import from us. So therefore, the exports to that extent is not impacted in case of refrigerant gas and chemicals business. But for packaging films, yes, to some extent.
And with the sort of plunge rupee took in the recent months, that seemed to have, sort of played well for you, right?
Sorry, repeat.
With the plunge in rupee against the dollar, that seemed to have played well for you, right?
See, as I had said, it's export-oriented, yes, it does play well, but you must understand there are imports also. So whenever there is a drop in demand in particular on the export side, you'll have to maintain the natural hedge, we'll have to ensure that the imports also come down. So we have to shift to the domestic supplies as well. So it is, I cannot say it plays well. We have to strategize accordingly that it plays in our favor. I mean, depreciation of rupee does not always play well so much. To some extent, yes, because if you are competing with Bangladesh, if you are competing with Vietnam, where the currency has depreciated more, if you want to make your exports competitive, perhaps you want to keep the rupee at 80 to 82 rupees so that you still remain competitive. But to that extent, yes, but overall perspective, if you look at the supply and demand side, it doesn't always, I can never say that, depreciation of the rupee is always helpful.
That helps.
Thank you.
Mr. Agarwal, if you can also, share your perspective in terms of the investment shaping up. You are a CFO and that's an important territory of a CFO to make investments. So how are your investments sort of lined up? And I'm not sure if your sector is like capital intensive that way. And you have cash for that matter.
Irrespective of the cash, I think investment decisions are more forward-looking in nature. And as Hemant also rightly said, unless there is a structural change that we are foreseeing or forecasting in terms of the demand patterns going negative, interest rate hikes alone will not impact the capex decisions. In fact, given the state of uncertainty for the last 2 years and let's say slight slowness in capex expenditure in the last 2 years, we are actually going overboard and we are investing ahead of the curve because we firmly believe that the market is very ripe for growth in retail in India. In fact, still almost 80% plus of the market is still in the unorganized segment, and whatever retail that we see around is hardly, 10 or 20% of the total market size. Now, given that backdrop, the opportunity is immense. There is no shortage of capital if one were to say, not only from our internal resources, but more even from an external perspective also. There is enough demand and there is, more opportunity for us to grow, and therefore there is no holdback on the capex decision.
No holdback, and you are already overboard as you are saying. Okay. Mr. Ruia, I think in the last answer you indicated that you might as well defer capex should demand be significant, should demand significantly face pressure. So do you foresee such situation? And I mean, what sort of planning you have already made?
Well, I wish, within inverted commas, I was an oracle or someone else. Possibly I could have really minted money had I been a soothsayer. But on a more serious note, I think what people are saying, and I'm only amplifying certain sound bites which people like y'all tell us. US may is the word, see a recession. People are bloating over the fact that India will not. So Europe is like on the throes. So if that be the case, or if that were to come true, then exports for sure will get impacted, at least in the industries where we export to these two continents. But I still believe, and again, there's a big rider that India does not go into a recession. The domestic consumption, if it plays out, and as Anand said, that, save discretionary spending, the rest of the spending stays, and the government anyways is going to go full hog on the infra piece in the country. I do believe that it may not impact so much on the capex plans. Because you see, capex plans are a derivative of the demand plan. I mean, it's one level below. So the first thing that gets impacted by interest rates hikes, as Yuvika said, is broadly the leverage spend and the discretionary spend. These two are the first line of attack in the armory of central banks to bring down or curb inflation by hiking interest rates. So once that is done, then there could be a waterfall effect on the other sectors. But given all that we are hearing, India's domestic consumption may not be impacted, hence the capex plans may not go too awry, unless, as I said in the first thing, that unless you're sitting on those ROIs which are, very minuscule, and some impact may put you in the negative territory. That's something which you really can't forecast.
Well, that gives a fair bit of clarity, Mr. Ruia, thanks. So let me come to Yuvika for her comments here. And as an economist, you would be able to throw some color on the trend of the private investments. We have been saying, I think, since last 5 years, it will pick up. Second half, it will pick up. Then pandemic came and it never picked up. Now, what is your sense? Is capacity utilization continuing to remain low, or do you think there is some turnaround in some sectors?
Right, Manu. So I think India, in its true sense, has not seen a private capex cycle, at least for good 7 to 8 years. And we had harped about in the past of India facing the twin deficit balance sheet problems, one on the sides of the banks, others on the sides of corporate, how the mismatch just never allowed animal spirits to come back as far as the private capex cycle is concerned. I think at this point in time, having seen those cycles, both the banks went through, the capex at the corporate level went through, I think I would be fairly confident to say at this point in time that never in the last decade I've seen a very positive confluence of factors come in favor of a private capex cycle takeoff as I'm seeing at this point in time. And let me explain why. From a macro perspective, the biggest parameter for gauging investment or investment interest is capacity utilization levels to us. And obviously, capacity utilizations fell dramatically during the COVID period, but as per RBI's latest survey of capacity utilizations, we have seen levels back at 75%. This is a broad macro number. We know for a fact that certain sectors and certain companies are operating almost close to full capacity. We also hear from a lot of clients that they have CapEx plans very actively in place, largely because they are unable to cater to the demand that they are seeing in a particular sector. So 75 to us is a very good capacity utilization level. It's not just above pre-pandemic levels, it's also above long-term capacity utilizations levels that we have seen for the economy. Second, the push that the government has indicated on its capex, and typically we look at government capex spending as a factor which crowds in private investments. So somewhere the government capex has to take a back seat to let the private sector capex cycle to take over. But it's a good crowding in factor that you know infrastructure creation is happening, some kind of money is pumping into logistics, roadways, transport, so on and so forth. So you know that for your business to grow, there are certain, favorable factors or facilitator role that the government is playing is somewhere happening in the background. So that becomes very important to us when we look at factors that are or could probably help a capex cycle revival at the private sector level. And third and most importantly, I think, is the turnaround that we have seen in the balance sheets of the corporate sector. The pandemic gave them that window to, strengthen their balance sheets to a large extent. It also helped them bring down debt to a large extent. And at this point in time, I think for a large number of sectors, the balance sheet, the health parameter of the balance sheets is extremely strong, and they are actively either investing in a capex cycle or are looking to invest in a capex cycle. The two factors which are probably, weigh on everybody's mind is one, demand. Where do we see demand headed? Where do we see global demand and domestic demand? Global demand we know is going to take a hit in the next 1 to 2 year horizon, because the kind of aggressive rate tightening that we have seen, the risks of a hard landing are fairly real at this point in time. But if you are a domestic-oriented player, I still see that there is a huge scope for consumption to grow in the Indian economy. We still have sectors that are under-catered, not saturated enough, and there is still scope for the pie to grow as far as domestic consumption is concerned. So if you're looking at capex, you're not looking at probably a 1 year horizon, but you're looking at it from a 5 year or a 7 year period horizon, because your capex plan is not going to come on board overnight. So you need to keep in mind what we are forecasting as far as demand estimates for a particular, your sector or any other sector is concerned, or the economy as abroad. And there, I think there is no dearth of optimism as far as scope for growth in demand is concerned. So I think these two factors are extremely important to keep in mind. Third, and I would, agree to my fellow panelists here, that interest rate hike, and, we see this in analysis that we do. So as economists, we hear a lot of anecdotal evidence, but we always go back and look at numbers and see whether it's actually reflecting in what the data tells us. And we do find that when we do our regressions, that borrowing costs do not make a big difference to the investment cycle. They are an important parameter, but not as important as probably demand visibility or the health of the balance sheet for that matter. So the increase in interest rates that we have seen should not be a deterrent as far as capex cycle is concerned. If you have the visibility of demand and if your balance sheet is healthy enough, and you see your capacity utilizations moving up, this is the time to invest.
So, ceteris paribus, like if the pace of the interest rate hikes continue in the same fashion, do you then think significant pickup in private capex next financial year?
I think that's a very wrong question to ask, because interest rates are not going to continue monotonically move up. So we have to understand how the dynamics are changing in the economy. So yes, when RBI started to raise interest rates, we knew we were looking at a strong or probably an aggressive rate tightening cycle. We started somewhere with 100 basis points, but as and when inflation numbers came in, we realized that, they'll have to act more aggressively. At this point in time, our assessment is that we are not looking beyond 50 basis points hike for the beyond, I should say, at least we are penciling in, I should say, 50 basis points hike of incremental rate tightening by RBI between the next two policy meetings. Thereafter, we believe that RBI will take a pause. They will reassess the impact of past rate hikes. They will reassess what is happening as far as inflation is concerned. They will also have to assess what is happening in the global economy. How much of that hard landing is actually looking more real when we are towards the end of this calendar year. So to my assessment, the kind of or the pace of tightening that we have seen so far is not going to continue at the same pace in the second half of the year. Also because there was a need to front load rate hikes. Understand, we are going to see a very healthy growth number emerging out of Q1 because growth has been fairly resilient. But as we progress in the second half of the year, in RBI's own assessment, second half of the year GDP growth is pegged only at 4%. With 4% GDP growth, where will you have the bandwidth to keep hiking at the pace that they have in the first half? So the pace hikes have to come off. They will have to peak off. Probably another 50 basis points is what we are penciling in at this point in time. Situation remains dynamic, largely from a global front. We have had the comfort of a commodity price correction. A lot of positives are also flowing in. Given this scenario, given this economic milieu, I believe that another 50 basis points hike will not really be killing capex plans per se.
Sure. So, Joydeb, let me come to you for another round of questioning, so to say, and that is, you mentioned at the very beginning, that one of the impacts of the increase in the rate hikes is on finances, like your interest cost, sort of goes up. And then secondly, I think you also mentioned rupee depreciation doesn't necessarily mean, like an advantage for exporters. There is like always certain aspects that come into play and that way perhaps mitigate the entire sort of advantage. So herein, if we were to just ask you the strategy that you have sort of seen for yourself, like next 2 years, 3 years that you have outlined for yourself, be it in demand, be it investments, what is the vision that you are targeting for your company? And what is the path that you are planning to navigate? Does that path rule out the possibility of recession completely, or does that have it?
So, actually, I can't give specific numbers, any share price sensitive numbers, but what I can say is we'll make significant investments in our chemicals business. There's no stopping there. Strategy, one is what we are looking at now is to completely deplete our dollar loans, which we have. Okay, because across the globe we have various business units where we have a mix of the local currency loans and the dollar loans. We're going to deplete that and shift to the local loans, one, because Thai baht loans are not so much impacted by this because the interest is around 2 to 2.5%. Europe is negative spread, so 0.5%, so that euro loan is not an issue per se. Second thing is that we generally, what we do is, you have seen our numbers,
Yes.
So numbers are quite healthy over the last couple of quarters and always has been healthy. So we try and plow back the earnings back into the same segment of the business to keep the debts low. So, the strategy is that as we, because our chemicals business has a very healthy EBITDA margin. So what we do is we reinvest back into the business, whatever investment we're planning into the chemical business, largely from internal accruals. If we had a 50-50 spread, now we are looking at around 70-30. So loans will anyway be there because it cannot be completely internal accruals, but 70-30. And strategy one, as mentioned, we just trying to get rid of our dollar loans. Because earlier, if you see the dollar to euro, it was at 1.16, 1.14. Now it is 1.02. I don't know what it is today. I think it's 1.02 still. So look at the volatility between dollar and euro. It's a huge volatility. And I think sooner or later, dollar will overtake euro. It may be on the other side.
Okay.
So that's the strategy to start with. But no stopping investments. One, simple.
Okay, and recession, I mean, of course, nobody hopes here, but you don't expect either, right? Global.
See, as she has just mentioned, rate increase cannot go on to shoot down demand completely. Demand has to be there. There has to be demand as well. So what she has said is absolutely right. You cannot keep on increasing interest rates. And I do not see much coming further, maybe 0.25 later on, depends how it is. But Recession, I am the wrong person to give that answer. I think she was the right person
I
on
was
that.
just, trying to assess when you are strategizing your plans. I mean, as a CFO, you would have factored in that worst case scenario, or would you not have?
Of course we have. Of course we have. So what is happening is we are, see, as I have said, there are multiple business. If you decide to, if you thought that we would have invested, we would invest some amount of money in packaging, now we're shifting to chemicals. Simple that way.
Mr. Agarwal, what does your strategy look like in the next 2 years from here on?
So, listening to Joydeb, talk about recession and, Yuvika also speak about recession. First, let me just add to given my 2 bits on that. मेरे को ऐसा लगता है कि I think we are overplaying on the recession point, and particularly even for the US economy and मतलब it's not the first time ever that US is getting into technical recession. Recent as 2009, they had a short amount of recession, and उसके पहले 97, 98 के आसपास recession हुआ था. But these are small blips. And it's not just the recession which is going to, take you under. I think this is also one of the first recessions where you are seeing job growth along with, recession. So which is a very contradictory signal. From a US perspective, I think the bigger points which are playing on everybody's minds is more of geopolitical risks and more of global uncertainty, which is, creating a lot of supply-led havoc, and which is creating that inflationary pressures, and therefore to counter that, a lot of countries have to resort to different measures. But coming to your specific question, as far as my company goes and our business goes, I think we are quite gung-ho, as Yuvika rightly mentioned. The time to invest is now. India in particular is going through a phase where we should see citrus paribus, we should see a strong spurt of demand coming in, I don't know very soon, but definitely, in the near future. And one has to be prepared for that. And investment cycles are not for 3 months or 6 months. We do prepare for the next 5 to 10 years, and therefore our investment plans are definitely far more optimistic than they were at least, let's say, 2 years back or 3 years back.
Mr. Ruia, if I can come to you and quickly ask you, because I think we seem to be running out of time. So what does your strategy look like? And do you have any view on the interest rates from here on, like as a CFO? You also see like 50 basis points from here on and then go for a pause?
Look, I believe that the interest rate increases that all central banks do, they are done with the specific purpose of cooling the economy. They are never to to make inflation zero. They are always to rein in the inflation. Correct? So no one is saying that your inflation should be 0 or should be 2% and I'm going to keep increasing it till it's 2%. You're given a broad gauge of, let's say, RBI says 6%. Okay, 4% plus minus 2. Now, if that be true, I strongly believe that we are human beings. Okay, the first thing that we do is to say, oh shit, this is going to hit me, this is going to hit me hard, and you go into a tailspin. That's, we are all human beings, and we always first think the worst. I believe that, if you should always have the worst at the back of your mind, but as Gita says, karmanne vadikaraste ma phaleshu kadachana, please go ahead and do your best, leave the rest. Have it at the back of your mind that things can go into a tizzy, but it should not be your anchor. Your anchor should be something which is rooted, and it is optimistic, and you must have a plan B which says, okay, if things go in a tizzy, what am I going to do? So I am optimistic, and especially given the fact that we are in this great country where we do believe that domestic consumption is going to only increase, I'm optimistic about it.
Great. Great, sir. Yuvika, if I can ask you like a similar question, but also add on to say that, ask that there is a lot of, there's a lot of queries and questions among consumers. And if I can, on behalf of my colleague Alek, can ask you, there's a question that सस्ते दिन कब आएंगे अब इंडिया इकोनॉमी में? So ये जो 7% inflation है हमारा, do you really see it, even if after pause, do you really see it 5.5% FY24 somewhere? या नहीं आएंगे सस्ते दिन?
सस्ते दिन आएंगे. 24, FY24 seems something more likely. So in our minds, as per our assessment analysis, we think that, so we have seen an inflation number of somewhere around 7.3% for Q1 this year. We think it will be elevated around 7% for Q2. Q3 will mark the inflection point where inflation will come dramatically lower, almost 100 basis points. So it could hover around 6%. It will also be the turning point because you will see inflation slipping below 6%. That is within RBI's target band, broad target band, by the end of the year. So maybe the November or the December reading will give you comfort. And then it could start to slip, 5.5 levels by Q4, 5% by next year. This is the kind of glide path of inflation trajectory that we are forecasting at this point in time. And I'm saying this again at this point in time because there are too many moving parts. Also, for the year as a whole, this year we are looking at inflation at 6.5%, which is 20 basis points below RBI's assessment. We have not touched this number. We have not revised it lower despite commodity prices globally seeing a very sharp correction. Why so? Largely because we still feel there are a lot of pipeline inflation pressures that are yet to reflect on the CPI numbers that we'll still see for the months of July, August, and so on. Why so? The GST hikes that we saw on a large number of items of mass consumption happened in July, yet to reflect in numbers. In addition to this, a lot of state governments have, or state electricity boards have hiked state electricity tariffs. That is yet to reflect in numbers. Also, the comfort that we get from the global commodity prices is likely to be felt larger on the WPI than the CPI numbers. And this is exactly what we saw last year when commodity prices were rallying. We saw WPI prices rise at a much faster clip, and that wedge between CPI and WPI was very, very strong. So now on the other side, the comfort will be greater on WPI, but not as much on the retail side of inflation. So we have to keep these factors in mind. So even then, we are living with a number of 6.5 for this year, and probably at 100 basis points, maybe lower, 5.5 or 5% maybe next year. But we'll have to see again how the monsoon pan out, how the food inflation pans out this year, next year. A lot of ifs and buts. And globally, let's see how things shape up. Whether we do end up in a recession a year from now, we don't know.
Sure, thanks. So what we would typically quickly do is we would like to open the floor for Q&A. And please, if someone has any question, please feel free to ask to any specific panelist or otherwise.
I know it's been a long day for everyone and everyone is looking for a closure. But I have this question to you, Yuvika, and being a student of economics, I can't resist to ask you a question. One is that we've all kind of agreed that the cost of borrowing is not going to bring down investments, and I think that's very clear from all the panelists. But as a consumer, my propensity to consume versus my propensity to save will become. So as an individual, my consumption is going to go high and my savings are going to go less, which will boil down to the GDP in terms of if you combine all the, the growth per se, or the spend per se. So, my question to you is that, is it really a trade-off as you talked about, or is it more got to do with what's happening in the market?
Consumers, something that, we always talk about is the real rate of return on savings, and that for the longest time we know has been a negative, looking at where the real rates, interest rates are and where inflation is. But I think increasingly when you hear RBI commentary, we feel that they are becoming mindful of this fact that the propensity to save is getting lower and lower in the economy because of that negative real rate of interest. And in our own assessment, we believe that given that we still see scope for another 50 basis points rate hike, also inflation could be closer to 5% level next year, the real rates of interest could move into a positive territory in FY24. And that, to our minds, will be an important event because that will give the incentive to save to a consumer. So while, yes, we have grappled with high inflation, as consumers, we are looking at high inflation almost across the entire consumption basket, whether you see it in food, whether you see it in fuel, with pent-up demand and demand picking up. It's almost across the core basket of inflation, also remaining above 6%. But for savers, I think the wait is slightly longer, but we'll get there probably next year.
Thank
Can
you.
you-
That's really reassuring. Thank you.
Good evening to the panelists. With geopolitical tensions only increasing, the recent China-Taiwan issue, and if it further increases, and already Russia-Ukraine war in progress, is there a possibility of stagflation entering in the world economy? I am talking of stagflation instead of inflation. Stagflation could be the real worry.
I think,
So, yes, I think we are in some sense in a stagflationary scenario. I will not deny that, though growth is still doing decently well in a few of the economies, but we know it's on a weaker turf. The kind of rate hikes that we have seen across developed markets, look at where inflation is 9% above in US, 4-decade high in a lot of markets, whether it's UK, Europe, Eurozone, US, the world over is combating high inflation at this point in time. And central banks globally are in a mission mode because they want to bring down this inflation. And they have left probably, I should say, no stone unturned in terms of rate hikings, withdrawal of liquidity, etc., to bring down inflation. Now, the hard fact here is that when you will see inflation turn, you will also have to cool down the economy, and the growth that we are seeing now is probably going to move even lower. For example, IMF's estimate for US growth next year is 1%. And for all you know, it slips into recession, but the base case scenario is 1%. It is already forecasting a recession-like scenario in Eurozone and UK and so on and so forth. So yes, maybe stagflation is a story which will gather pace as we move towards the next year, and it will be a reality if inflation still has a leg to move up, and geopolitics is one angle which is beyond the control of central banks. So if we were to see another black swan event emerging out of Asia and it creates a havoc on supply side, which central bankers and monetary policy has lesser control over, we will definitely be in a stagflation situation. But that is not our base case scenario. Our base case scenario still builds in that inflation will come lower given the kind of rate hikes that we have seen, and probably, yes, growth will slow down, but we will not see as elevated inflation that we have seen this year. But in a black swan kind of event, we don't know. That could be a situation that we have to deal with.
okay, so that's where we will come to an end. But one quick question to the CFOs, which is, what is their biggest worry? Is it demand or inflation, or if neither of them, then which is?
Some of the business demand, yes. Of course.
No, it's actually both, because they are very interlinked. It is not either or. So with inflation, as we all agreed, inflation drives demand behavior. So it's actually both.
Sir, for me, dhanda. If there's no business, we can kind of keep speaking on inflation and the drivers of inflation till cows come home. But dhanda nahi hoga to kuch nahi hone wala.
Yeah, sure.
So for me, I think it's dhanda, and if dhanda is basically demand. Okay, so I would put all my bets on demand. If that does not change significantly, the rest is all
All right. Thank you.
Skimming.
Sorry.
A lot of times internally, inflation or input price can be internalized to some extent. You can look at ways to reduce costs when you are producing a certain product. It could be packaging, it could be in delivery distribution. So some part of inflation you can internalize, and we saw that last year. So despite WPI prices rising the way they did, 15% inflation at this point in time, we did not see producers pass on that price rise to a large extent. But on the other hand, if demand tanks, it's an exogenous factor that you'll have little control over. So,
Okay, so that's where I leave, the lady had the last word. And thank you so much, panelists, really means a lot. And thank you so much to the audience for actually, being so patient. And I think we seem to have hold you up for the cocktail. So thank you so much.